Hi, everyone. Jack Farley. I'm here with Keith Jurow. Keith Jurow is a housing analyst. He's been a longtime Real Vision fan favorite, pointing out the risks that are hidden in the housing market that others can't see. He's a columnist at MarketWatch. You can get his columns at marketwatch.com. Keith, welcome back to Real Vision.
Great to be back, Jack.
Yeah, great to have you. So I want to start out, Keith, with the notion of a housing recovery. The media is replete with stories that the recovery in housing has been robust. You look at new housing sales, existing sales, case Schiller, which I know is a metric that you are not a fan of. Why is this mainstream narrative wrong in your view?
Okay, I've been writing about the so-called housing recovery for 10 years now. And I've been pretty much alone in making the claim that this recovery was phony and it was built on false narratives, and I've probably taken a lot of heat for it. But why don't we start out with? But that's a fair question. Why don't we start out with new home sales? Just came out a few days ago. New home sales strong. Seasonally adjusted annual sales were a little over 1 million. Now that's very strong compared to the last several years. Those are seasonally adjusted. I never look at seasonally adjusted. Give me the raw, unseasonally adjusted sales, and I'll take it from there. When you look at the unadjusted sales, you have roughly, for monthly, which is telling us what happened in August, roughly 83,000 new sales nationwide. That still seems pretty strong. However, when you get into the weeds, like I like to do, 60% of that, roughly 53,000 sales, were in the South alone. Very strong, not surprising. You add that to the, I don't know, maybe 19,000 sales in the West. That's 90% of all of the new home sales in the country were in those two regions. How many in the Northeast? 4,000. A year ago, 3,000. So pretty much, and Midwest a little, maybe 9,000. So you take half the country out, which where the sales have been weak for some time, and you have basically a strong southern new home sales. Hard to tell exactly where they're coming from, but I know that some of them are coming out of, ready for this, New York City, and some of the larger southern metros. You know, you've heard about that. People want to get out of the city. They can work from home. And so that's what they're doing. They're going as far as Florida from New York City. They're leaving by the hundreds of thousands. And that's not the only reason, but it's a good part of it. And that will account for, like I said, 90%, the two West and the South, 90% of those strong sales. So forget the housing recovery is strong around the country. It's not. And when you look at it that way, it's, it looks quite different. And but they never talk about that. They just use annual, seasonally adjusted sales, which tells.
Sorry for interrupting your video, but I have an important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on Real Vision's YouTube channel, that is just the tip of an iceberg. You should come over to realvision.com and see how we are not leaving any stone unturned, from publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts and fellow subscribers and learn from everyone's experience. It is an experience which you live and you learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think you can afford to be without it.
It's, it looks quite different, and but they never talk about that. They just use annual, seasonally adjusted sales, which tells you little. But I like to dig into the weeds to see what is going on at the local level. Existing home sales, I think it was National Association of Realtors showed pretty strong sales. I never look at NAR's figures. I've actually talked to them in terms of how they derive their numbers. They're not real numbers. They have algorithms that they use to come up with, which I couldn't understand. They're not real numbers. So I go for that. I disregard NAR and I go to Redfin, which is an online brokerage firm. And their numbers I have found to be pretty accurate and real. If you do that, what did August's figures look like? Flat. No increase between August of 2019 across the whole country. That's substantially lower than NAR's figures. And I was a little surprised myself. There's one strong area that stands out. You can't miss it. And that is where I used to live, Fairfield County, Connecticut. Up almost 40% from last year. Now, all of Connecticut's sales, which I see details for the whole state, have been so lackluster for several years. Why a 40% increase? Simple. It's people fleeing New York City. I'm sure you've heard about it, you've read about it. Town after town is very strong, Greenwich and as well as the rest of the town of Connecticut, and it's up much greater than anywhere else. They're coming out in droves. This is very unusual, and there aren't that many metros that I can think of where the sales are even up double digits from a year ago. Some are up, some are down. It's really pretty uneven. There are some strong southern metros where the sales are up low double digits. But again, I suspect that those may be people moving out of the inner cities, the metros of major areas. But even last month, July, it was up nationwide. It was up maybe 4 or 5%. That's not what you will read from NAR. That's why people have to read these numbers really carefully. And I just will not go to that website to get their numbers. So all in all, this great housing recovery during the summer of COVID, it ain't all what it's cracked up to be. And I'm really very impressed. And since August sales are down from July sales, September could even be worse. It could put it into negative year-over-year figures, and so much for the housing recovery. It's a little too early, but don't believe everything you read in the major media outlets.
That's really interesting. You cited the latest statistic for existing home sales for August. One statistic you shared with me in the emails we were swapping before this is the nationwide delinquency rate for all FHA insured mortgages, which in August rose to 17.4% from 17.0% in July. What are your thoughts on the rising delinquency rates?
All right, well, let's start with FHA. Remember, they're insured by Federal Housing Administration. Typical down payment for years has only been 3%. The underwriting is always weak. The required FICO score is lower than it is for other kinds of loans. And another thing that is hardly talked about at all is that since about 2016, there's been a lot of refining going on, and many of those refis of FHA mortgages were cash out refinancings. Now, I've written a lot about the problem with cash out, where you take out a loan that's larger than the original loan and you keep the difference. And I would say the last 3 years, perhaps half or more of the FHA refinancings have been cash outs. So they're in over their head. The delinquency figures are not surprising. New York City and Long Island, the delinquency rate is pushing 30%, but it's nationwide. You've seen that. Those figures are nationwide, and they're getting worse. And the question, of course, we'll talk about it in a little while, is what are the servicers going to do about that? Is kick the can down the road still in effect?
Yeah, I'm glad you brought that up. On Real Vision, for the many times you've been on Real Vision before, you've been very forward in talking about the games that mortgage providers as well as lenders are playing, such as not putting repossessed homes on the market so it doesn't decrease the price, as well as mortgage servicers floating to the creditors the interest and principal that the borrowers are not paying. So they've been playing these games for a long time. And the dominoes have been lining up with the cash out refis, as you said. So I guess my question for you is, now, because of COVID and because of the mass insolvency that we're seeing across the nation, what do you see going forward? We've had all this tremendous pressure building, and it seems like this COVID could be a catalyst for something very extreme. What are you seeing?
Let me back up a bit and talk a little more about the delinquencies, put it in historical perspective for those viewers who may not have read any of my columns or seen my earlier interviews. Starting in 2000, it took me several years to figure out what was going on with the lenders and the servicers, because I couldn't understand after the crash how the so-called turnaround had been so strong. But they had the servicers and the lenders had a three-part strategy. One was, first, you don't put on the market very many of the foreclosed properties, and we're talking about millions of them. And then when that didn't work, you simply sharply curtail the number of delinquent properties foreclosed. That seemed to work a little better. And then the last piece was, well, those long-term delinquencies, which were still out there, and there were a lot of them, we'll just do mortgage modifications, where you rewrite the mortgage, and then once it's rewritten, whether it's extend the term, whether it's capitalize the delinquent, that was a favorite. You capitalize the delinquent arrears. So instead of a $400,000 mortgage, by the time they were modified, you had a $500,000 mortgage. But once this was done, and then you could lower the interest rate as well, so the payments were a little lower. And we're talking about millions of those modifications. You put the three of those together, and it still took about till 2012, early 2013, before prices began to go up. A lot of people don't realize that. It took a good 5 years before these three strategies could turn around the market. And to a great extent, that strategy continues today. They're still doing those three things. There's as little foreclosure going on now as there was at the height in 2010. So we're talking about a strategy that goes back 11 years now. And it took me several years to figure out what was going on. And then I finally started to write about, here's what's happened that has turned around the housing market. And that's why I always called it the so-called recovery.
That's great. You talked about how foreclosure rates are very, very low, even as delinquencies are quite high. Can you talk about why that's the case, and the sort of the moratorium on evictions as well as foreclosures, and why, if you look at the chart of delinquencies as well as foreclosures, generally they tend to map each other pretty well, with the foreclosures sort of trailing the delinquencies by a year or two, but in this case they're just polar opposites. What are you seeing there?
It used to be that. It used to be until 2010. But if you took a chart of since then, you'll see that the delinquency rate has always been much higher than the foreclosure rate, consistently all the way down. And the strategy, I can't prove that this was intentional, although it seems pretty obvious. But the services They couldn't afford not to, and the lenders weren't prepared to foreclose on millions more than they already did. It's been roughly 7 million since the crash began. But the delinquencies, I think you saw the chart on how delinquencies of FHA loans or subprime loans, which were the worst, they trended down for 10 years since 2010. But with COVID, they started spiking up the last few months. They're all up substantially. That's pretty obvious. I mean, I know we're going to get to how can this continue, and how is it possible that kick the can down the road can continue indefinitely? But remember, since 2009, this strategy has worked. Mm-hmm. It's worked. It's if you keep most delinquent properties from being foreclosed or from being sold, you have that has had a lot to do why listings of homes have been down so substantially. I mean, it started in 2010, but it's coming back now. Listings, if they were foreclosing on all the millions of delinquent properties now, the listing of properties for sale would soar, and that would really put a damper on not only prices, but the whole market itself. So it always made sense to do that. And, I'm asked all the time, why should they stop playing the game? I call it a game that's worked, even though a lot of people, except if they listen to me or read my columns, wouldn't have a clue as to what's going on. They see the figures that we talked about in terms of home sales. Prices are up from a year ago. Well, yeah, I mean, if you artificially restrict the number of homes on the market, that's going to artificially push up prices. So, I don't pay much attention to prices because there's not really a free market of buyers and sellers that there would have been if these actions weren't taken.
So just to follow up on that, which parties are restricting the supply? Is it the lenders that repossess the homes and just keep them on their books? Is it the mortgage servicers? Like who's holding the bag, so to speak?
Good question. A lot of people think it's simply the lender that forecloses, but that's not really true. The mortgage is serviced every month by mortgage servicers, and they're the ones who are in charge of not only putting in modifications, deciding whether or not a property should be foreclosed, and actually putting it on the market. I mean, the lenders sort of have to go along with that, but the servicers have a lot of discretion as to what they do. And they're going to do whatever it takes for them, frankly, to survive. It's not easy, but part of the problem is that the big banks used to service 2/3 of all of the mortgages in the country. But they got out of it starting around 2012 or so. They sold off their servicing rights. So now maybe only less than 1/3 of all the mortgages are serviced, by the big boys. And they were taken over by what are known as non-bank lenders. These are lenders who are not traditional. They don't take deposits. They get their money short term. It's kind of risky for them, but they have bought the servicing rights, and they don't report to anybody. The big banks report to the OCC, and we have good data from that. But then once the non-bank services came into play, we do not know what is going on with them. It's like a big black hole, and it's made it harder to know what's going on in terms of anything, foreclosures, delinquencies, redefaults on modifications. So that's changed a lot, and I try really hard to see what I can find on the non-bank services, and they're willing to take more risks, but they borrow money short term, and for mortgages, that is a risky game to play. But they now probably service more than half of the mortgages that are outstanding.
I think would you use the term for the housing market of the past 10 years? You'd say the recovery has been an illusion. But would you call it a bubble?
Bubble is about the most overworked word in not only mortgage markets, housing markets, but in the stock market. I really don't find the term helpful. Maybe I should come up with a better term than that. I use the term illusion because it looks to be a recovery. When you dig down into the weeds under the surface, it's not as strong, and there are real reasons for that. What would you call that? I mean, I like the term illusion.
I like illusion as well. You've been pointing out how the signs of recovery, the strong signs, have been illusion, and you've also been pointing at the hidden stresses within the system. When do you think that these hidden strains will ever materialize and exert a downward pressure, sort of a doom spiral on the market, sort of that we saw in 2008, or something that's very, very extreme? Do you think that is possible? And specifically because of the COVID crisis, do you think that will be a catalyst for making this happen?
Why can't the recovery, the so-called recovery, and kick the can down the road game, why can't it go on indefinitely?
Exactly.
I'm asked that all the time, and that's a fair question. The game began in 2009, so it's been going on for 11 years, and there's no end in sight, especially with now that the moratorium on both evictions and foreclosures has been extended by FHFA to the conservator of Fannie and Freddie to the end of this year. So, that has changed the game again. So why the burden's on me as to why it can't continue. Let me give you an example. The Commerce Department came out with August retail sales just a little while ago, and they were actually up slightly from a year ago. Now, how is that possible? Moody's came up with these figures. There are something like 17 million people who are earning less now than they were before the COVID lockdowns. Well, and that's only the people who are still working. Then, of course, you add on to that those people who are still not working, who have lost their jobs. How could retail sales be up? Seems crazy, doesn't it? Well, I did some digging, and it turns out there was a survey done in around May, and it showed that 30% of all the people surveyed, it was a pretty good sized survey, had started dipping into their retirement plans, 401ks. And another 20% hadn't already, but were planning to do that. Well, that's one way. I mean, the cash is there, it's theirs. The CARES Act, that Congress passed in the end of March to help out people who were losing their jobs, it encouraged that because it said you won't be penalized with that. Remember that 10% penalty for early withdrawals of your retirement plan up to $100,000. Well, if you give people who need the money the opportunity to tap their 401k plan or their IRA up to $100,000, they're going to do it, and they did. So half of those surveyed either had started or were planning to do that. The interesting thing is, as early as 2015, Jack, I think it was Bankrate, had found that people already had started tapping into their retirement plans. Something like 20 million had done so in 2015. Even though at that time there was a penalty. They were willing to take 10% penalty. For whatever reason, they wanted or needed the money. Now, what does that tell me? That tells me, I think, that even today, people are trying desperately not only to pay their mortgages, but to maintain their lifestyle. It's very hard to say, yeah, I can't do it anymore because who knows if my job is coming back. But if I tap my 401k, okay, I'm robbing from the future for now, but I kind of like all of the things I was able to do beforehand. That may not be the right interpretation, but it sure looks that way to me. So that's once I discovered these kinds of numbers, I said, well, that certainly is helping people to spend money that they really didn't have in terms of their income. And that makes a huge difference in terms of, if you just read the Commerce Department's retail figures, you wouldn't know any of this. But I think that's the key.
Yeah. You mentioned, I want to talk about the Federal Reserve because you mentioned something about the housing. But first, quickly, you said that people want to maintain their lifestyle. And that made me think of something you said in one of your previous interviews with Real Vision about the trade-up housing economy, how everyone I buy my house from you, and that allows you to buy a better house. So it's just this virtuous cycle a circle that's virtuous until it isn't. Do you think COVID has been sort of a catalyst for trade-up economy of urban professionals leaving their cities and buying new places out in suburban havens?
Great question. I started writing about the trade-up market. I don't know, maybe 8 or 9 years ago, because the whole housing market was built on that. First-time buyers bought a house, and that enabled those selling their house to trade up to a bigger, larger house because there were profits that they had gotten from the sale. And I said, probably as early as 2012 or 13, the trade-up market is dead. Without those profits, you can't trade up to a bigger, nicer home. And it took me a couple of years to realize that, well, maybe it wasn't completely dead because of the strategies that I mentioned that the services were doing. If you live in an area with a strong housing market, you can still trade up. Matter of fact, there's an outfit called Atom Data whose numbers I use all the time, and they actually have I think it's a quarterly report on people who actually sold their houses. They would look at what their previous sale when they bought the house 6, 7, 8, 9 years ago, how much profit. These are real numbers because they looked at 2 sales and looked at the difference in the gross sales price. And I've written about it and posted a graphic, and there's a huge difference. New York City, it was only 20 to 30% for several years. Hard to trade up with that because once you take out the commission, you're not left with that much. If you need a bigger down payment, you might not be able to have it. But until a year and a half, 2 years ago, you could do it easily in Seattle, Portland, the California cities, because the recovery was strong enough that they could do that. But I still think that there are areas where it's not so easy to trade up because there aren't enough profits for them to do that. But it hasn't disappeared. It'll only disappear if prices start turning down, which hasn't really happened yet. But I'm not too optimistic about the next year in terms of prices.
Yeah, let's talk about prices. What would have to happen in order for prices to decline?
That's a good question. I mean, prices haven't really declined in many major metros. I focus on major metros. And like I said in my last column, it was more because of the plunge in houses for sale. You have to look at it both sides. Is the demand that strong, or is the supply that limited? And to me, anyway, it's far more important to look at the supply side, because because of the interest rates, if you can get a mortgage below 3%, I mean, that's irresistible. But most of that, the last 3 or 4 months, has been refinancing. The purchase mortgages, I mean, they're up, but it's not that substantial. What could turn prices down? Well, let's get back to how long. If I think that this COVID what's happened with the COVID lockdowns is something that's long term. Will that impact prices? I mean, I think it will. For example, we talked a little bit about the mortgage situation. It's not just FHA mortgages. It's all of the non-prime and subprime and now what's called non-qualified mortgages. They all have double-digit and mortgage delinquencies approaching 20%. But as long as they're not put on the market, it still won't affect prices very much. Do I think that can continue? Let me give you an example. There's something like 100 million non-mortgage loans that are outstanding that have forbearances on them that would have been delinquent had the lenders not decided to work with them. These are student loans and car loans. Car loans are getting up there, the delinquency rate in well into the double digits, and that's going to continue, especially since car loans the last few years were given to people who probably shouldn't have obtained them. But remember, when money is easy and the rates are low, lenders are going to open the spigot, and that's what they've been doing. But what about there are something like 15 million small business owners, and I wrote about this in my column, and they've been devastated by the fact that their tenants can't pay their mortgages. I mean, the survey that I had in my column showed that the percentage of those who were not fully paying their rent to these small landlords, and there are 10 million of them or more, dropped from 82%, I think, to 55%. So almost half of them were not able to pay all or part of their rent, but there's no moratorium on landlords trying to collect the rent. No, I mean, no, they have a lot of them they've owned it for a long time, and they have the house is free and clear. A lot of them don't. But while the moratorium on evictions is great for the renter, it plays havoc with the lender. These are small people. They may have one property. 90% of them own less than 10, and many of them are older, and they rely on this income, and they are being devastated. So I said at the end of my last column, I wouldn't be surprised if millions of them eventually, they may have to liquidate the property because they can't afford to keep tenants in there who don't pay the mortgage. That will have a huge impact on the housing market. Does that mean prices will turn down? The one thing that will cause prices to turn down is if there are large numbers of homes on the market and incomes of people either stagnates or starts to decline, where maybe the unemployment rate continues up. The key is going to be what do the lenders and the servicers do. It's hard to know how many it's gotten very difficult for me to find out how many delinquent properties are there out there now, much more so than 4 or 5 years ago. What if they put even a fraction of them into foreclosure and put them on the market? That could easily look like a repeat of 2009, 10, 11, 12. I'm not saying it's going to happen, but the potential is there because a lot of these people have not paid their mortgage in 5, 6, 7, 8 years or more. That's why, I laugh when I say it, because the lenders don't care. And, well, I shouldn't say they don't care, but the servicers don't care. They're going to do whatever it takes to survive. Should that happen, though, at some point, I've always thought that it can't go on indefinitely. At some point, if the number of delinquencies is so great that the servicers feel compelled for whatever reason to put the properties into foreclosure, that will pretty quickly put a damper on any rise in prices. I don't have a time frame. Remember, I don't have a crystal ball. I never put a time frame on when this will happen. I talk about risks, and the potential is there, and I don't see how the potential could continue for much longer for this housing market so-called recovery to maintain itself unless something happens that I'm not aware of, like the mayor of New York City says, oh, all the restaurants can now not only reopen, but reopen to 100% capacity. That is not going to happen.
Yeah, definitely. I guess just what you said about the moratorium on evictions. There's a moratorium on eviction, but there's not a moratorium on rent. The people who are renters, their rent is piling up, right?
Great point. I mean, people forget that. Well, I don't have to pay my rent. Oh, that's great. It's well, at least they can't throw me out. Now, if I'm able to pay, I should at least pay part of it. But it's very uneven. I mean, I hear stories from the landlords where some people are trying to do their best and they're trying to work with them. But a lot of people will scam the system just like they did with the mortgage. The stoppage of foreclosures. They're going to say, if I don't have to pay, I'm not going to pay, and I'll worry about that later. I'm good till the end of the year. Do you think that FHFA is going to all of a sudden say, okay, now it's not nationwide. This is only mortgages guaranteed by Fannie and Freddie. It's not nationwide, and there are some states whose own moratoria have expired. So, for example, in Houston, evictions have started already. So it's very uneven, but it's not the whole rental market. We're talking, I mean, there are far more people who rent than own. All it does, it also pushes the can that you still owe that rent. If you don't pay your rent for 9 months, you may owe $10,000. And at some point, I think a landlord's going to say, well, you got to pay me something. I cannot pay my mortgage. And who knows what's going to happen there? I don't know what FHFA is going to do come January. Nobody really knows, but it doesn't do away with the rent, as you say. It just postpones. It makes it harder in a sense for a tenant who has all of a sudden has $10,000 that they have to come up with. It depends on the reasonableness of the landlord, and that varies from landlord to landlord. But one more thing we should mention: what could finally the housing recovery has at least maintained itself stronger than I would have thought. What could put an end to that? Mm-hmm. I've thought about that a lot, and I think maybe the stock market is the key. Now, I don't write about the stock market, but I follow it very closely. And, the downturn when the lockdowns began was swift, but it turned around. It turned around pretty sharply, and we're right up, not very far from the all-time highs. And my question is, what happens if we see another turn down in the stock market, maybe breaking the lows of late March, and it doesn't turn around? There's a lot of optimism out there in the stock market, rightly so, and there still is a euphoria, and there are people willing to buy the dips. But what if that breaks down and goes to new lows? What if that euphoria were to disappear and people's risk-taking all of a sudden there's serious reservations about that. That could have an impact not only on stocks, but on the housing market and all markets as well, because, the stock market's the biggest one of all.
Definitely. Your point about the stock market makes me think about the Federal Reserve, which since this crisis started has served as the backstop for credit markets and the bond market. And that has really helped shore up of credit risks within the system, as well as by lowering rates, it makes stocks and other risky assets more attractive just because the treasury yields are yielding basically nothing. My question is, what role do you think the Fed has served in the recovery? And by the recovery, I don't mean the past 10 years. I mean the sort of somewhat miraculous recovery in the housing market over the past
it's huge
months or so. Yeah.
I mean, you can't underestimate it. The the Fed has gone further than it ever did, even 2008 and 9. I used to work with economists many years ago when I was in academia, and I said, my God, they live on a different planet. They do. And that's true for the Fed. The world that we see and the world that they see are totally different. And, they just think that it's manageable to bring short-term rates down to basically nothing, to bring mortgages or force mortgage rates down to below 3%. I'm not sure that that will work in the long term. I've always wondered, why are people willing, especially in Europe and Japan, elsewhere, willing to give their money to an institution that is charging them, not paying them, to keep their money there? I have no idea why people do that. I don't know if that game can go on forever. Americans dumb enough to be willing to put their money into an institution that doesn't pay them any interest? I mean, to me, it's insane. But I think that the Fed thinks that they can manage that. I'm not sure. The Fed tried to do all kinds of things after the stock market crashed in 1929. Nothing they did was able to work. It was just too big a problem. And eventually people started pulling their money out of the banks. I'm not saying that's going to happen, but I'm always less optimistic, Raul is as well, that the Fed, they really think they can manage something like this and that they have control over this, and they won't be hit with any black swans. But wasn't COVID and the lockdowns a black swan?
The ultimate black swan.
Really, and I still think that, like I said in my column, this is really something new. It's different this time. I hesitate to read too much into it over the long haul. We don't know what's going to happen, but we haven't had a black swan in the same way in the stock market. But I taught and I've studied history long enough to know that you better prepare for a black swan coming at some point. The unexpected will grab you, and if you're not ready for it, at least prepared to change direction in what your strategy is. That will be bad news. But don't get me started on the Fed, because they're smart folks, but their world is a world of algorithms. I don't know if half of them have ever been inside of a real business, and they haven't the foggiest idea of what businessmen do or what they're prepared to do, and the adjustments they're making. Let's not get started on that.
Well, actually, I do have just one quick question: is how much of the support the Fed has given has been through indirectly by lowering rates and backstopping the credit markets? That's just increased confidence, which allows banks to hold, they're more willing to hold on the books because they don't have to liquidate these properties. Or has it been the support that they've supplied through the mortgage-backed security market?
That's a great question, too. I mean, in a sense, it's all of that together. I mean, at the foundation of everything is really what? Investor confidence.
Mm-hmm.
1932, savers lost confidence in the banks for good reason, and were doubtful that they could get their money out in time should something terrible happen. And they started pulling money out in 1932. Once that happened, it cascaded across the whole country. There was anything anybody could do until Roosevelt called the bank holiday when he first took office. I mean, so confidence is everything. If people lose confidence that the stock market will either turn around after a downturn or that it will continue up, I mean, that will change. That investor psychology is the key. Obviously now there's still a lot of euphoria that people are confident that any dip is the time not to sell but to buy. So it's a combination of those. I mean, and it's hard to put a handle on it. They terrify me, the Fed, because like I said, I've worked with these kinds of smart economists, and they don't see things the way you and I see. So what may seem crazy to you may make perfect sense to them. And when they talk about, well, our goal in inflation is we have to get it up to a certain, why do you want to get inflation up? I mean, what if it got, don't they remember the 70s? I don't know, but they are truly scary. And you have to anticipate at least that they will do things that are unimaginable, and but perhaps might not work if all of a sudden people get really scared. They're not scared now. Nobody's scared of really anything terrible, especially since the lockdowns, they've started opening up, although I'm in New York City, and Fifth Avenue is still like a ghost town. Most of the retail stores on Fifth Avenue are shut, and now is the time to be cautious, to maybe to assume that bad things could happen. Think of possible other black swans, like you mentioned, and now is not the time to be a huge risk taker. There's a time to be a risk taker. 2009 was a great time for, at least in the stock market. I don't think this is one of those times. This is where you really better read your risks carefully and be prepared for bad things to happen. And what are you going to do then?
Definitely. I want to say if the Fed is successful in shoring up the stock market as well as the real estate markets for, say, the next 2 years, do you think that is an opportunity to reconsider the thesis about the housing market? Because, as you said, this is a black swan, and if this doesn't cause the edifice to tumble down, what will?
Yes, tough questions. I hesitate to use the term thesis. I don't know if I have any thesis that suggests, there it is, and all I have to do is prove it. And no, I mean, I reach conclusions based upon the research that I do. But 2 years, it's hard for me to, given the lockdowns and everything that's happened since March, it's hard for me to go out 2 years in terms of what could happen. If, again, it's not my bailiwick, but I mean, if the stock market if the indices were to go to new highs and without a major turndown, I'd have to rethink that one. But I don't know. How many people take a look at the new highs and new lows in the stock market every day? I do. And maybe a week ago, there were 10 new highs on the New York Stock Exchange and 90 new lows, telling me that this rally is the FANG stocks and little else. And but the rest of the market has been either going nowhere or even heading down. But all I do is try to dig deep and research into the weeds where it's important, especially in terms of the housing markets that I write about. But 2 years, come back in a year and ask me that question. Maybe I'll have a better grasp on it. But right now, I'm going month to month to see what we can see, and there have already been a lot of surprises in the last 6 months. But some people will say, well, Keith, you're just a doom and gloomer. No, I'm not. I just call them as I see them. If I see things that look like there's some real problems and risks, I'm going to write about them. And if I didn't write about them and at least point out the dangers, who would?
Yeah, absolutely. I just want to make clear to the viewers at home, I actually I've learned a lot from your work, Keith, and some of the charts that you've sent me through the latest TCW report, which maybe we'll put in the description. The charts really are unbelievable if you look at the delinquency rate. And to me, and again, now I'm speaking as someone who has an opinion, where when I was challenging you before, I was doing my best to be an objective journalist. To me, it seems very tough when the delinquency rates are so high and the foreclosure and forbearance rates are so low. It seems that it is artificial because of the federal moratorium on evictions and foreclosures. So it seems like either the moratorium is indefinite and being a landlord is no longer a profitable activity, or there has to be a major correction. To me, I don't know. I just wanted to, now that we're sort of at the end of the interview, I just wanted to share my view.
That's a good point. And just one more thing about forbearances. Remember, they're temporary deferments of paying your mortgage or other loans as well. But they're temporary. They're meant for an emergency. They may go 6 to 12 months, but they're supposed to end at that point for the most part, unless they're continued. And why is it that there was no more than 4.5 million of them in terms of the mortgage market? There are over 50 million mortgages, but there was around a month after the lockdowns began, there was an interesting survey done that showed that of those who said they were very worried about paying their mortgage, which was something like a third of those surveyed, 40% of them hadn't even inquired, what can I do about it, from their lender or the servicer, if they even knew who that was, but even asking the lender. Now, why? The forbearance information wasn't all that clear. It wasn't that widespread. Maybe some didn't think it mattered. I mean, it was really puzzling. They just didn't even inquire. And those that inquired, not all of them actually said, am I eligible for a forbearance? So, I mean, that in itself is really puzzling, but it suggests that, I don't know, when it comes to mortgages, people weren't that worried. Maybe they knew people down the street who hadn't been foreclosed for 5, 6, 7 years. I mean, it's puzzling when you see these things, but when you have the kick the can game going on for 11 years, it affects people's mindset. And they think, well, the Fed will handle it, or I'm not going to get foreclosed. And sooner or later, they just don't take a look at risks at all. And I suspect that a lot of them will get hurt because they're not prepared to something unexpected or even a black swan for that to take place. I'm not sure that answered your question.
It did, actually. That was really helpful. So, Keith, one thing you said earlier was that you were walking down Fifth Avenue and that you saw so many stores were closed. I know your work mostly focused on the residential real estate market, but do you have any views on the commercial real estate market?
Yeah, I used to write about the commercial market a couple of years ago and stopped because my real interest is the housing market. But the commercial market is also, it's hard to fathom because a lot of take New York, the worst case. I mean, the retail stores were getting killed. People weren't showing up, and a lot of them were forced to shut down because they didn't have landlords who were willing to work with them. Some are, but a lot of, this is New York City, tough landlords. If you can't pay your rent, we'll find somebody who can. Well, when I saw that, I began to wonder, well, who's going to take their place unless we get people coming from out of state into New York City? I didn't see that happening. People are fleeing by that James Altucher article. 400,000 people, he estimate, have already left Manhattan, and we're seeing signs of it. They're buying homes as far south as Florida, as far west as Texas. So, the market is weak. It depends on on what, retail is weak, but storage is not so weak. And the commercial real estate is a big market. I mean, would I be a buyer in this market for office properties? Probably not. But the commercial investors, these are big boys, a lot of them, most of them, and they're eternally optimistic, just like builders. They're eternally, you give them the money at low rates, they're going to build. The people who are talking about, buying a property for $1 billion or more, a year or two ago. I mean, they still think there may be bargains out there, and if prices, some markets are very weak because there aren't many buyers, but there are those who I think are prepared to step in. If you step in Manhattan, that's, to me, seems pretty risky. But, it varies from place to place. Some of the big metros are getting hit pretty badly, San Francisco, Los Angeles. But it's very hard, and I'm always reluctant to generalize because once you get down to the local level, it varies, from metro to metro. And but it's obviously been hit by the lockdowns. Nowhere worse than New York.
Yeah, definitely. You mentioned James Altuchers' piece. That definitely caused quite a stir. We actually were lucky enough to have James on. He spoke to one of our editorial staff, Ash Bennington. And I want to ask you, what do you think? What do you make of James' thesis? It sounds like you largely believe that the COVID has made living in cities less attractive because you can't go to bars, you can't see your friends. So all of the risk, the urban premia that you would pay to live in a city is no longer making sense. Is that right?
He was talking about New York City. He's a lifelong resident of New York City. I read his original article, and boy, it was pretty scary and pretty compelling. So when he goes looking for his favorite restaurants and he finds they're all shuttered, and then he goes and he can't. The Broadway is closed. I walk past the New York Public Library, that's closed. There's a mask over the lions. So it's sort of inconceivable what's happened to New York City, but nowhere else in the country as far as I know, is it illegal to open your restaurant indoors. Now in Connecticut, we have 50% capacity, and the mayor and the governor has said we'll go to 75% October 8th. So they're open, but in Manhattan, you still cannot open the inside of your restaurant at all. I mean, I've read just recently that 90% of the restaurants in Manhattan, I think we're talking 25,000, could not pay all or part of their rent. And the fact that there's still restaurants still in business is only because their landlords are trying to work with them. But that's Now, his view was that New York is never coming back. And, he took a real beating for that. But he knows the city like the back of his hand. I only lived here for 3 years. I mean, eventually something will come back, but it's hard to imagine where there's a lot of lawsuits now in terms of the restaurants have filed a class action suit against the governor and the mayor, I think, as to why. No, I think it was against the mayor. Why? No, I'm not sure. Maybe it's both. But as to why, how can you, in Nassau County, I can open my restaurant, but I can't open it 500 feet to the west in Queens. Now, I grew up in Queens, so I know well, and it's crazy. I used to teach law, and I don't know how I could make a case if I were defending the mayor and his actions. So that's working its way in the courts. I don't know how long it'll take, but it's just sad to see what's going on in New York City. But I mean, Los Angeles has taken a beating too, and San Francisco and Seattle, and we'll have to see how it plays out. You never know what's going to happen in terms of actions taken usually it's by the government or the Fed to try to prevent bad things from happening. But in history, bad things always manage to happen, even if you try. If they're going to happen and there are fundamental reasons, it's really hard to keep the plug in the dike for too long. But I mean, these are times to be cautious. Doesn't it make sense to be cautious? There are times to be very cautious and times to go ahead and take risks. That was 9-10 years ago.
Yeah, definitely. Just quickly on the real estate thing, I actually got my haircut a few days ago, and the barbershop, it normally has 3 stools, but they had to get rid of one, so now they have 2 stools. So they have 2/3 of the revenue. But is their landlord asking for 2/3 of the rent? Maybe not. Maybe they are. So that is such an interesting question, and I hope I feel like we've barely scratched the surface, Keith. Your thinking is very, very deep as you look very deep in the weeds. But I just want to thank you so much for your time. I definitely would love to have you on Real Vision again. You're a fan favorite.
It's great to be back. I'm glad I had a chance to update things because so much has happened since the last time I was on, and look forward to being back again.
Definitely. All right. Thanks, Keith.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.